So now you know how to find the crime scene. You know how to spot a lie. You know exactly what it looks like on a chart when the whales of Wall Street come in and start absorbing shares in a panic sell. But what do you do with this? How do you trade this on Monday morning? Wall Street wants you believing that trading is just a guessing game. They want you to believe it's just luck. They want you to believe that you are just too dumb to understand how to trade.
Beavis, you're a stupid dumbass.
That without their Ivy Leaguers in a suit charging ridiculous prices or their expensive courses that you can't do it on your own. I'm here to tell you that's all a lie.
Bullshit?
Every time one of these institutions make a big trade, they leave a footprint. And if you know how to look for those footprints, you can make some money too. In part one of this video, we talked about the crime scene and the lie detector test. I showed you how whales come in and absorb money during panic selling, and how they leave a massive footprint that we can track and profit from. But remember, I also told you not to catch that falling knife or you would get bloody. Today, I am going to explain to you how we can safely look at the charts in order to determine whether or not that bottom is truly in or whether the knife is still falling. My name is Rob. I'm a former mergers and acquisitions attorney at a top 10 Manhattan firm. I'm also a former faculty member at a top 8 business school. I'm a real estate entrepreneur, and I've been trading these markets for 25 years and profiting from it. And it is my goal to get you rich, smart, not fast.
Nobody ever made a dime panicking.
Make no mistake about it. Wall Street wants you selling into a panic. They make billions of dollars relying on your fear, knowing that if times get tough on a particular stock, eventually you will get out and they will be able to buy it on the cheap.
Today is Greedy Bastard Day.
But what if you could just look at a simple chart and know exactly when that bleeding stops, know exactly when that knife is no longer falling? In this video, I'm going to show you exactly how to do that. We are going to look at basic candlesticks and basic patterns and treat it as a cheat code. I'm going to give you the exact visual green light that confirms that the bottom is in and it is time to start buying.
CBS News has confirmed the Justice Department has officially launched an investigation into the cause of last week's collapse of Silicon Valley Bank.
It comes as regional bank stocks are rebounding today. They were hit hard by the shockwaves of Silicon Valley Bank and Signature Bank failing. Many other regional banks had to halt trading on Monday after their stocks tanked.
Let's get in our time machine and take it back to the spring of 23. Seems so long ago now. Tay-Tay had just broken up with Joe Allen, hadn't started dating Matt Healy yet, and still hadn't even met her tight end. But there's something far more concerning going on than Taylor Swift's game of boyfriend roulette. In March of 2023, Silicon Valley Bank, which was a major lending institution for tech startups, goes under. Its panicked clients rush to withdraw their cash. All the talking heads and pundits on CNN and Bloomberg are speculating who's next to go down. They settle upon Charles Schwab.
Bye-bye.
And that takes the stock to the slaughterhouse. Retail traders like you and me are terrified. We are convinced that Schwab is the next one to go under. So when that market opens on Monday morning, everybody hits that sell button. Total panic sets in. Let's take a look at the charts to see what that looked like. First, let's take a look at where they are in February and early March. If you notice, Schwab is trading between maybe 82.5 a share down to about 75 a share. And then we have the gap down. You see that hole here? That's what we call a gap down. Bad news comes in overnight. The pundits start telling people that Schwab is about to go out of business, and all of the sellers come in. We have panic selling, and you can see the panic selling all the way down dropping. Next day, all the way down dropping. We get the weekend. March 13th comes along, and there's more selling, more selling, more selling. That candlestick wick goes all the way down to 45 a share. We now have a crime scene. But we still have to run it through the lie detector test. We have to look to see if the volume spiked enough that we can feel pretty sure that this move is a bottom. And sure enough, look at that volume.
Oh, wow.
It's like Schwab on that day traded about 149 million shares. Ordinarily, before all this started happening, it was trading maybe 8 or 9 million shares a day. And just visually, look at that skyscraper. Look at that spike. So now we passed the lie detector test. We know there's a crime scene. but we need to know whether or not that knife is still falling. So we don't want to get bloodied up, right? And to do that, we determine whether or not on the following day, so this would be on March 14th right here, the stock traded higher than the high of the previous day. So on March 13th, which is our day one, the high was at about 54.90, I believe. The following day, the stock ends up trading all the way up to 61.14, it looks like, and has a low of about 54.83. So the question becomes, did Schwab trade higher on March 14th than its highest point on March 13th? The answer is absolutely yes. We can see that in the chart. That means there's a good chance that the knife has stopped falling.
Oh, yeah.
And that the bottom is in.
Oh, yeah.
But we don't ever want to take that for granted because nothing is sure on Wall Street. You're going to need to buy some insurance. Let's talk about our insurance policies. Okay. So we're pretty sure that the bottom is in. We've seen high volume, we've seen panic selling, and we've seen the stock rise above its former high. But you never know on Wall Street. There is never anything that's 100% sure. So I want you to buy insurance. And that insurance comes in the form of a stop loss or a stop limit. Now, if you don't know a lot about stop losses and stop limits, we have a whole episode on the Takeover devoted to that, which I highly recommend that you check out.
It's a shameless plug. Shameless plug. Yeah, it's just a shameless plug.
Think of it like buying insurance for your house. Wall Street just built a concrete floor at $45 a share for Schwab. But what if that concrete breaks and Schwab falls below $45 a share? You're now losing money. You need to get out as quickly as possible. You can't afford to lose your ass. So you buy insurance. And that insurance comes in the form of either a stop loss or a stop limit.
Brilliant.
And the distinction between the two is important. A stop loss is a market order, meaning that whatever price you set it at, the minute that stock hits the price or below, it will sell and get the best price that it can. So, by example, let's say you set your stop loss at $44.90 a share on Schwab. The minute that stock hits $44.90 a share, the stop loss will be triggered and you will be out. You'll have lost the 10 cents a share if you bought at 45. The risk on a stop loss is what they call gapping down. So let's say Schwab closes at 45 a share. Stop loss has not been triggered. Overnight, some horrible news comes into play. It's going belly up. It opens the next morning at 40 a share. You are now going to sell automatically at 40 a share. Which, if the stock were to keep on going down, isn't a bad thing. However, though, what if it was panic selling right at the market open? Pushes it down to 40 a share, but by 10 o'clock, it's at 43. You've now just lost your ass because it's a market order. That's where stop limit orders come in. Stop limit orders allow you to set the price at which you will sell on a loss. So going back to our Charles Schwab example, you set the stop limit at $44.90. Overnight, the stock drops and opens at 40. At 9:30, when that stock opens at 40, your stop limit doesn't get triggered until you hit the actual $44.90. So you'll still be holding on to it. So if the stock returns back to 44 a share and you notice it and you say, you know what? It's not $44.90, but I'm going to get out now. You still just saved yourself a ton of money. But you've got to be proactive. You've got to be constantly monitoring your stocks in order to take advantage of a stop limit. What I tell people is this: be completely honest with yourself. If you have other things going on, if you have a family, if you have another job, if you have other activities, and you cannot be sitting there watching your stocks every day, set a stop loss and just forget about it.
Forget about. Forget about. Forget about.
On the other hand, if you're like I am, if you're constantly watching the market, if you're constantly watching your positions, a stop limit is a great way to protect yourself. Either way, in order to truly benefit from finding the bottom, you've got to buy the insurance.
There was panic on Wall Street
Atmosphere
as
on
markets
Wall Street
crashed
shut
after
down for
computer
hours,
hackers took
trading
control of
halted,
the
401ks.
Associated Press.
Wall Street is notorious for using the financial media to induce panic, thereby forcing regular people like you and me to sell at massive discounts. They are the casino and we are the target. And if you don't know how to read the chart, you're just another sucker at their table. Once you learn the charts, once you learn how to identify the crime scene, to determine whether or not the move is a lie, to determine whether or not there's a green light or the knife is still falling, everything changes. You stop being Wall Street's exit liquidity, you stop playing their game, and you start making your own rules. You are now stealing their playbook. Remember, everybody, knowledge is leverage. If you like what you saw today, I want you to hit that subscribe button, turn on the notifications so you'll never miss another breakdown, and we'll see you next time on The Hostile Takeover.